but I asked Adrian if he would mind kicking off the class by giving us his insights on the market. And just to set the tone, today is September 22nd. Yesterday on the 21st, the Fed raised rates by 75 basis points for the third time in a row for the fifth raise of the year. And you lucky dogs, they have two more meetings this year. I look forward to that. So what's your crystal ball tell us?
Well, I mean, the biggest thing, the reason that rates have gone up so much this year is just based on inflation. So just to kind of simplify how interest rates work for mortgages, it's a debt instrument, so it's a bond. So anytime there's a fixed return, inflation erodes that return. So if investors don't believe that inflation is under control, they don't want a 30-year debt instrument because their return is going to be eroded until inflation is under control. So each time the Fed has been raising these short-term rates of 75 basis points. In June, we were at some of the highest rates we've seen all year going into that meeting. And then we had 13 days of positive trading in the bond market because investors finally said, okay, the Fed is taking inflation seriously. We can buy these mortgage-backed securities and feel secure that our return isn't going to get eroded. Same thing happened in July, going in some rocky trading, and then long-term rates improved. So when your clients say, oh, the Fed raised rates, a way to kind of get on the decision-making team is to say, well, that's short-term rates, bank borrowing rates, HELOCs, car loans, mortgage rates don't follow that same criteria. Now, the Federal Reserve does not control long-term rates except for when, after the pandemic and some other quantitative easings, when they buy mortgage-backed securities by the billions, rates were artificially lower because they bought $130 billion worth of mortgage-backed securities in months and carried that through for a full 2 years. In March this year is when they first stopped buying them. And then not only did they stop buying them, so they were the biggest investor over the last year in mortgage-backed securities, they then quickly changed course and said, we have to run off our balance sheet. So now they stopped buying and they're adding supply to the market. Obviously, that had a dramatic effect on interest rates because not only are there inflationary concerns, now the person's been buying them. The government that has been buying them then is adding supply to where obviously the yield has to increase for investors to come back to the market. So that's kind of the reasons we're seeing this. Now, I think what happened today, we kind of had a really rough day in the market again. The investors aren't believing that the Fed is going to stick to this course. They've been aggressive the last 3 sessions at 75 basis points, which when they did it in June, that's the first time they've raised that much in 30 years. But they said some things yesterday that led to some concern, right? So they're trying to play both sides of it right now a little bit, and they're kind of chasing their tail. They were already so far behind the curve on inflation, which is why they had to change course so quickly. And some of the things, as Ed probably knows, that they said yesterday did not give a lot of confidence in the bond market as far as investors go. So we had a really rough day again today, and obviously, even Barry Habib didn't expect this reaction. So I wish I had a crystal ball. I can't say exactly, but I would say, when I'm talking to buyers about the opportunity that they have right now and negotiating seller credits and 2-1 buy downs and all these products we have to help with affordability, that's the biggest issue. High prices and high rates, that is a challenge. Looking at that versus 6 months ago going $100,000 over and fighting against 10 people, and first-time homebuyers didn't have a chance to get a house right. So I much prefer this than what we had then, although it's just a lot more difficult because it's never fun for a buyer to see the payment go up as much. Especially, it's okay for rates to be higher, but when you get pre-approved at one amount and then it's completely different a month later or 3 weeks later, that's the hardest part. So we're just trying to educate them on what the market is doing, that it does change daily, that we watch it closely, that we can slow it down, that we can do buy downs, all these different tools that we have to manage it. But obviously, it's not a fun time. Now then we look at historical things where, Ed knows these are high rates within the last 8 years or what we've seen, but historically, fairly normal markets, 5.5%, 6.5%, 7%, not an issue other than when you come off of rates being below 3%, right? So that's the perspective that we've, lost track of over the last 2 years. We think that low rates are just a normal thing. That just isn't the case.
And I would just add to that, because this correlates directly to what you just said, is that buyers go through a grieving process of, oh shoot, I missed the 2.75 with 3.2, whatever rate they heard on, the radio. they get through that grieving process and they still end up on the other end, which is acceptance in the grieving process and the fact that they needed a bigger house or they needed to downsize or whatever the life event was that triggered them thinking about buying in the first place. So give them that time to grieve, give them this education, and then remind them that none of this interest rate movement is going to cause depreciation. So whatever they are thinking hurts now, the house price being higher 6 months from now is going to add to that pain, right? So it'd be better to buy now at 7 and then refi next year, you know, and remind them we've never had a recession in the US history where rates didn't go down. This is a unique situation because inflation is the worst it's been in 40 years. So the Fed has to take action. I don't know, did you ever look at Paul Volcker's move?
Yeah,
I mean,
Barry Habib shows all the things he did, and it's like a roadmap, exactly what we're going through right now.
Right.
Yeah.
And the minute this administration says this is transitory inflation, I don't know, crap, because that's the same term Paul Volcker used in the 80s, and you guys have all heard how rates went in the 80s. Well, it went to 18 because Alan Greenspan had to raise rates significantly to get inflation back under control because of his predecessor, Volcker, was an idiot. So the Fed is moving swiftly. I actually had a funny conversation in Dallas with probably one of the top 3 or 4 biggest influencers in the REO part of the market. We were predicting what the Fed was going to do yesterday.
Okay.
So I emailed him yesterday. I said we should have bet because I was right.
Yeah. Did you think a point or a half? Or?
He thought a point.
Okay. Yeah.
Yeah. So anyway, the lesson and what we wanted to get down on video so that you guys can share this with your clients is that it's still a great time to buy, especially when you factor in the mortgage guys saying is, you know, marry the house but date the rate. But that's never more true than when rates are nearing 7. So if everything holds true towards the end of next year, you know, inflation will start to get under control in the first half of next year, would be my guess. And then we'll start to see the Fed lowering rates for the economy. So.
And we still have an inventory issue. Like there's so many buyers on the sidelines right now.
Yeah.
Once they begin to enter the market again, this inventory that we think is prevalent, it's not going to get absorbed very quickly. Next thing we know, not only are rates, you know, maybe a little bit better, but if you have to push the price up and you're fighting against 4 or 5 people or more, then affordability is even a bigger issue than right now, negotiating, you know, all the different tools that we have to kind of make affordability better. But again, this is a much better situation than what we had 6 months ago. Even with rates being higher, you know, we have buyers going under, you know, $100,000 less for a townhouse, 0 down VA. I mean, it's crazy to think what that price was, you know, just 6 months ago.
Yeah, and I'll just add this for the end of this video because you guys can share this video with buyers. Like this is information that you don't have to memorize and make these words your own. Let Adrian teach them via a video. And so to end the video, we'll end with a success story that fits right into this. So I have a client who was writing $200,000 over asking in April and losing. They took a break because that was an emotional beating that they were taking, writing repeatedly, repeatedly losing, right? Took a break. In July, we wrote an offer, closed in August, 180,000 under asking, and that 180 included a $23,000 credit from the seller to buy the rate down into the 4s. So that's what he's talking about. We said we have tools, buy downs, float downs, all that stuff. So if you're a consumer listening to this video, the key is have the right teammates, right? Because not every team coaches on these sorts of topics, and not every realtor has these skills, nor a loan officer with tremendous skills. So thank you. Enjoy the rest of your day.